The matching principle in GAAP. The matching principle states that expenses should be recorded in the same accounting period as the revenues they helped generate, regardless of when the cash transaction occurs. Example, if a company incurs advertising costs in December that result in sales in January, the expense should be recorded in January, not when the invoice was paid. This ensures accurate net income calculation and avoids over/understating profits. Types of expenses in GAAP. 1. Product costs, inventoriable costs, directly tied to production or acquisition of goods. Include raw materials, direct labor, factory overhead. Capitalized into inventory until sold, then expensed as cost of goods sold, COGS. 2. Period costs not directly tied to production. Include selling, general, and administrative, SG&A, expenses. Expensed in the period incurred. Accrual versus cash basis in expense recognition criteria. Accrual accounting, GAAP. Cash accounting recognition basis when expenses incurred when cash is paid. Example, salaries earned in DEC but paid in Jan. DEC salaries paid in Jan. Accuracy in matching high-low. GAAP compliance fully compliant not compliant. Note: GAAP requires accrual basis to ensure consistent and comparable financial reporting. Common GAAP compliant expense categories. A. Depreciation, allocation of the cost of tangible assets over useful life. Methods: straight-line declining balance units of production. Example, equipment costing $10,000 with a 5-year life equals $2,000 per year. Depreciation, straight line. B. Amortization, same concept for intangible assets, e.g., patents, licenses. Typically straight-line method under GAAP. C. Bad debt expense, estimated using allowance method under GAAP, not direct write-off. Complies with the conservatism principle. D. Accrued liabilities, incurred but unpaid expenses, e.g., utilities, wages. Recorded via adjusting journal entries. E. Prepaid expenses, payments for future services, e.g., insurance, rent. Initially recorded as assets, expensed over time. F. Contingent liabilities, recognized only if probable, likely to occur, estimable, amount can be reasonably measured. Capitalizing versus expensing. Treatment: capitalize and expense. 1. Definition: record as asset, expense over time, immediately record as expense. 2. Examples: buildings, machinery, software development, office supplies, travel expenses. 3. GAAP rule: capitalize if benefit extends greater than 1 year, expense if benefit is immediate. 4. Impact: boosts short-term profit, higher assets reduces short-term profit, lower assets. Red flag: aggressively capitalizing operating costs to inflate earnings is fraudulent under GAAP. Expense recognition examples. Scenario 1, a law firm pays N300,000 in December for a 1-year insurance policy starting in January. Treatment: record as prepaid expense, asset, in DEC, amortize monthly starting in January. Scenario 2, a bakery pays salaries for December in January. Treatment: accrue salaries in December using adjusting journal entries. Scenario 3, a tech company capitalizes R&D expenses. GAAP violation: R&D is usually expensed unless related to software development after feasibility. Ethical and regulatory issues in expense reporting. Manipulations to watch for: delaying expense recognition to boost profits. Capitalizing normal operating costs. Underestimating bad debt provisions. Consequences: SEC enforcement, restatements, investor lawsuits, damaged reputation, criminal charges, in severe cases, notable case, Enron disguised debt and inflated profits via special purpose entities, violating GAAP expense and disclosure rules.